Hi everybody, it's Andy Phillips here, and we've got our tax expert Mark Barrett. Hi Mark.
Yes, good afternoon. How is everyone? I hope you're well, Andy. Hope everyone else is.
Yes, I'm pretty good. I'm pretty good, and you're looking good and sounding fantastic. I've got to
Thank
say.
you.
And why?
I've been a techie boy. I've put new cameras on and I put new microphones on.
And it's all working.
Because the son told me how to do it, because I didn't know. But yes.
Yeah, it does sound really good. You know, again, if anybody's interested about these sort of things, you know, getting this little bit of tech, because we're all online nowadays. You know, you might as well try and use the best sort of things, so condenser mics and good cameras and things like that. And it really does help a lot. So nice little tip as well. So anyway, we're going to be talking tax as we normally do. And do you want to just introduce what you're actually going to be talking about today? Because I think this is one that people are going to be very interested in.
Okay, when you look at the whole raft of subjects, setting up your business, whether you're self-employed, in your own name or in a company, very important. We did that recently. I've tried to stop people doing things illegally with dividends. I've tried to do that one recently. And this one, I've focused on the huge subject, and it is huge, everyone, of extracting cash out of your business. That's assuming that your business is a company. So extracting cash from your limited company. I'm afraid it's a lot of slides, and I'm going to bang on through them today, but so I'm afraid you're in for a little marathon unless I can talk twice as fast.
No, we're quite happy to go through this at a pace because we're recording this and putting it into the PIN community. Then people can just watch it over time and things like that.
Yeah.
Have a little break. Do you want to go up to full screen so we can actually?
I will do that. And are you ready for me to start?
Yep, got you up on full screen now. Brilliant.
Great. So hello everyone. So tax efficient extraction of funds from your company, big subject. Now, you'll be used to me by now if you've listened to other presentations. I keep saying, I'm just going to give you the overviews. You've got to go and talk to your professional, your accountant. Really important. And I'm now going to say it a few times. I'm going to sound like a crack record, and I apologize, but really important. So let's get on. Quick introduction of us. Yes, chartered accountants. Yes, doing this lots of years. Medium-sized firm, specialist for property. Personally, I'm a residential and commercial landlord. Been doing this for 30 odd years. I've been an investor for 25. The usual wealth warning and health warning now. This is not professional advice, and I keep banging on about this. You must take advice from your accountant. There'll be topics I'm going to deal with today, which frankly, we've spent a couple of years perfecting before we even tell you that we're doing it. I do get worried when I see a lot of social media and you got the 25-year-old that says, yes, I'm just at university, I'm an expert. Please just make sure you're getting expert advice. If ever you talk to your accountant and your accountant has that glazed look in their eye, or they say, yeah, I'll check that and come back to you, you've probably got the wrong one. Okay, let's crack on. So, big story. What are we trying to achieve here now? If you're the owner operator of the company, we've got to try and get money tax efficiently from the company pocket to your pocket. And when at our firm we look at this, we try to go through 3 steps. So just to explain all the steps we're going to take. Number 1, the ideal is where the company gets tax relief by giving you the cash. So visualize it. Company's giving us money, the company gets tax relief, so your tax bill's reduced, and you get the money, and ideally it's tax-free in your hands. Win-win. Perfect. Now, exploit every one of them. Once we've done that, and we can find no more, now we're looking at where the company gets tax relief, even if you don't. Because if your left pocket is getting 19% tax relief and your right pocket's paying 20% tax, if you're a standard rate taxpayer, it's tax neutral. We got the money into your pocket, tax neutral. Third and final, if we exhausted number 1, we've exhausted number 2. Now we've got number 3. Yeah, the company can't get tax relief. You're still going to have to pay tax. Damn, how are we going to do that with the least amount of tax? So those are the 3 logical steps. And once you've done those 3, I think you've got an answer to your question of how to extract cash. So let's move on. I like hopefully pick up on the first sentence there, don't yawn. Literally, we're seeing it all the time where people don't do this. And yeah, come on, please claim absolutely everything that you're entitled to all the time. Yeah. If I could save you 500, if I can save you 500 quid, put 500 quid in your pocket, tax free in your pocket, and I can get that tax deductible in the company every month. Wow, thank you. Because let's imagine now you've legitimately, please don't play silly bugger games, okay? Nobody wants to visit you in Pentonville. Legitimately claimed, say £10,000 worth of expenses in the year, you've got 10 grand in your pocket. The company's tax bill has been reduced by £1,900. The government actually gives you in your left pocket £1,900 because you put 10 grand in your right pocket. What's better than that? Claim everything in the lot. What we're often asked, give me a list, Mark. Give me a list of the things I can claim. It's not just about lists. It's mindset. So what I'm going to do now is just talk you through the process. As always, when we do these, I get clients listening, and they've been through this process.
Yeah, just quickly, just jump in if it's just 1 second.
Yeah.
The point of this is that when you're running a business, you need to genuinely find the best routes for lots of different disciplines that we have to do. Tax is one of them. And the best route really for doing this is to really think about this as it's sort of your obligation to try and minimize the amount of tax you pay, and to maximize your profits.
Yes.
Consequently, because if you can maximize your profits, all it means is you can grow your business quicker, faster, you can employ more people. You're actually doing something which it's not a selfish thing. I think a lot of people sort of think about this as it's like penny pinching and trying to grab the last bit of tax out of that went away from the tax man. No. But it's a very positive business structure and a business mindset to have, isn't it?
Well, it really is. And actually, for nerds like me, you go back to the 1800s and you talk about government and parliament and the Lords. There was a beautiful phrase in the Lords. Now, it doesn't have full application anymore. The accountants will know what I'm talking about there. Where one of the Lords said that it is the duty of the citizen to manage his affairs to his best advantage, not to the best advantage of the exchequer. So you're meant to do things to your best advantage. Now, as I say, that some rules have changed about that, but don't let the government put the biggest shovel they can into your resources. It's your money. You're doing this for you. Do it legitimately. Everything's legitimate. We will never, ever accountants doing anything that's not legitimate. Property is a long-term game. Quick story, Andy. Sorry, I'm going to use up time again. Had a chap came to us, came to one of my business partners on a Thursday, and said, "Could you help me fill in these bank application forms, please, so I can claim some bounce back loan?" To which the director said, "No, you're not entitled, and actually, filling in these forms accurately, you're not entitled." "Well, don't fill them in accurately then," was the response, which of course we declined. Friday, they terminated with us because we are too conservative. We wouldn't break the law. We're too conservative for them. How absurd is that? Amazing.
And it will bite them. I mean, the
prosecutions are faulted.
Yeah, I mean, HMRC are out there looking for people who have abused the system, and that's
the first bounce back loan prosecution has started.
Yeah, it's
ridiculous.
Whole thing about their job, isn't it? Anyway, so
yeah. Okay, I want to go back to mindset and lists.
Yeah.
So visualize. You're working with us. You're just starting out. What do you do? We do give you some bit of a list. Of course, we're going to talk to you about making sure you claim the Christmas, the annual party, the allowance for the annual party. You're entitled to that one. Make sure you claim your business mileage. Great. So there are some items on a list.
Yeah, some standard stuff. Yeah.
It's some pretty ordinary stuff.
Yeah.
We'll then give you some hints and education. And education is a big thing here. We'll talk about things like duality and all sorts. What we're trying to do is educate. If we can get your mind to work right. So we will educate. The next conversation, the client now comes back and says, I've got these 10 expense receipts. Can I claim them? We will go through them and not say yes or no. We'll go through and say yes or no because, and we will use it for education purposes. And you keep going through that process, but actually now we're making the client wiser until eventually the client comes to us and they will say, I've got these 5 more receipts. I don't think I can claim them. Why don't you think you can claim them? And then they will tell us why they don't think they can claim them. And hopefully they get it right by that stage. And we say, yes, you're right. What we've done now is we've looked at all the expenses that are already happening in your life. And lists might miss something that's happening in your life. That's why I don't like lists. But what I've done is I've educated you and I've made you a bit wiser. So mindset. Moving on. Benefits in kind. I'll deal with that in a few minutes, but let me deal with number 2, something called trivial benefits. If the company pays a benefit to an employee, and I substitute the word director here because we're using it interchangeably, and all the following apply, it's less than 50 quid, it isn't cash or cash voucher, you can't exchange it for cash, it's not a reward, and it's not an obligation, it's not in the terms and condition, then the company claims tax relief, but the employee doesn't pay tax on the benefit because it's a trivial benefit. But so therefore everyone's now going, great, I'll have 500 of them. No, you can't. If you're a director of a close company, now a close company is 5 or fewer shareholders. So basically, can you influence them? Is it a family? If you're a director, you cannot have more than £300 a year. But damn it, claim it. Take the 300 quid. Put it in, of trivial benefits, 6 times 50s. Take the benefit, get the tax relief, and do it every year. Okay, trivial benefit. Don't forget that one. It's a nice, simple one. It makes you feel good. So what I'm going to do now is I'm going to move on to benefits in kind. Everyone thinks benefits in kind, keep away from them. You don't have to keep away. It might be a good idea. So let's talk about that one for a moment. So let's imagine that the company provides a benefit. It is taxed via P11D. Yeah, all of these things have more paperwork. There's always paperwork. There's always process. Remember, I'm just telling you the question as much as anything else. There's paperwork behind it. Let's ignore cars. We'll talk about that in a moment. If the company pays a benefit, the cost is tax deductible in the company. Company has to pay national insurance on it, employer's national insurance. It's called Class 1A national insurance. The person who receives the benefit has to pay income tax on that benefit, but you don't pay national insurance. So how is this benefiting you? Well, think about it. What I don't want you to do, I don't want you to go out and deliberately try to find things to spend money on. That's not the name of this game. The name of this is, if there's a benefit that you already buy, you already want it. So I'm going to use medical insurance. The NHS is fantastic. But if you've got some elective work to be done, better that you have some medical insurance, get you back to work quicker. So medical insurance, I think, is a good thing to have. Let's imagine you're spending £700 on medical insurance. Now, if you had to earn salary as a standard rate taxpayer, to get £700 in your pocket to pay for the medical insurance, you've got to earn over £1,000 by the time you pay tax and national insurance. So you've already got 300 quid taxable before you even spent the money. But if the company paid for it, the company has to pay national insurance at 13.8% on the £700. You're not paying it on the gross now, you're paying it on the net. You will have to pay tax on the net, not on the gross. So what we've done is we've made the benefit, we've made the income not 1,000 plus quid, but £700. You don't have to earn such a large wage or have so much income coming in for you. Subject to your circumstances, benefits in kind isn't always bad news.
Right.
So let's look at, what are you doing in your company? What do you have in your life? Are you spending some money that you were going to spend it anyway? Should it be spent by the company instead? Let's look at benefits in kind. Okay, I said we do cars. Huge topic, huge. Too much for this presentation. If you're a client, please don't abuse this. If you're clients will talk to Paul Gosling, tax manager. I know he's done a briefing sheet about this. And we'll give you advice. But I'm just going to cover this in a fairly superficial manner, so bear with me. Let's imagine your business justifies a van. Now, obviously, as a firm of accountants, it's unreasonable for my firm to say that I need a van. You know what vans look like nowadays. Some of them are quite nice, Dolby surround sound, leather seats, air conditioning, the whole Monty, 2 banks of seats, big pickup truck, maybe. Make sure it's registered as a van. HMRC have fought and won several battles where vans are suddenly classed as not a van. They actually got down to measuring the gap between the back row of seats as to whether it's a load carrying space or not.
It's mad, isn't it?
It's just incredible. You see 2 pictures of 2 vans, you look at them and go, yeah, vans. No, one of them's a car. But if you've got a van, beautiful, and you don't use it exclusively for the business, you've got to pay tax on 3.5 grand, 3,430 quid. Well, that's, if you're a 20% taxpayer, it's cost you £700 of tax to have a super sexy, beautiful van. The company's got tax relief on the van. Wow, that's not bad. Obviously, some businesses you can't justify that you get a van. I can't. Let's imagine you want an electric or hybrid. Tesla's a beautiful car. At the moment, they're not taxed very high because normally you calculate the tax based on the CO2 emissions of a car. Obviously, electric cars don't have a CO2 emission, but they've now started taxing electric cars and hybrids. And the tax rate we know it's going to increase. They've already published the increases. So you could start to look at this and say, well, fine, I fancy a Tesla. We can calculate what the taxes are going to be on that over a 5-year period because the government's already published the rates that they're going to be in the coming years. Company isn't going to get the tax relief in the same way they're going to get it on the van, but maybe you get a nice car, not paying a lot of tax personally. I drive a big diesel A8 Audi, biggest thing I can find, biggest Audi I can find because I keep writing my cars off. I don't keep writing them off. I wrote one off, but it was horrible.
You don't ever exaggerate.
Yeah, I told you a million times. Stop exaggerating. I was coming back from a property presentation, thinking about it, and as you do after these things, and I rear-ended someone quite badly. Probably have that in your own name. Now, I keep saying, go and talk to your accountant, and if you get the glazed look, come and talk to us instead. Hopefully you talk to us anyway. There's always nuances. So let me give you a nuance that I haven't put on the slide. Just proof that let's find out who's listening rather than just looking at the slides. Let's imagine you're a car nut. I really am not. I don't understand. So if I say anything wrong about cars now, I apologize. So let's imagine that you're a car nut. You want to buy an MGB or a Spitfire or something. It's 18 years old. You pay 14 grand for it. Should you buy it in the company? Well, it's a classic car and it's less than 15 grand and it's more than 15 years old. Therefore, you're going to pay tax on the list price. Well, how much was a Triumph Spitfire 18 years ago? 500 quid, 700 quid? Well, paying tax on 700 quid is not a lot, is it? On a percentage of 700 quid, you're talking about probably £100 tax bill. There are opportunities subject to your specific circumstances where you might say, actually, this one I can put through the company. So there's always nuances. Talk to your accountant, ideally us. Okay, directors' fees and salaries. You can see them up to 5 already. And I know Andy told me not to speak too fast, but I am cracking on deliberately. I've got 11 to go through in total. So I'm halfway, folks. If you don't have any other earned income, you can visualize now that even though it isn't on the screen that I've underlined, I put it in capitals, I've underlined the word earned income. So you don't have a job. the first £8,784 will be completely tax-free in your hands, no national insurance, and tax deductible in the company. Now, typically the figures we're using at the moment is about £9,500. Yes, there's a little bit of NIC, but it gives you your state pension. So 87's a bit low. You might think about a slightly higher number, but for now, that number completely tax-free. If you increase it up to 12,500, then there is no tax to pay because that's your personal allowance. You've got no earned income, you've got no private portfolio, for example, but you have got a bit of national insurance, 800 quid's worth. But that's employers and employees. Now, you might be looking at that saying, well, I don't think I fancy paying anything to the government. Well, okay, keep that thought in your mind just for a minute. Don't decide yet. So now let's visualize. We've got husband and wife, and you've decided to take 12.5 grand each, £25,000. It's tax deductible. Wonderful. You get tax relief on it in the company, tax-free in your hands because you've got no other earned income. Perfect. But let's imagine your 16-year-old daughter is doing all your marketing, your envelope stuffing, leaflet distribution. I've already told you I've just installed some techie and I don't know what to do. So I had to get one of my kids to do it. Let's imagine that your son comes along and he works for you as well, and he does all your tech, he does your Facebook, he does all your social media, he does all of that because they're a bit better at it than we are. Why aren't you paying them? Why don't you put them on the payroll? Now, you could put them on 0-hour contracts, you could have them on annual contracts. Maybe they should be on the payroll. You're probably handing over cash to them anyway. Why aren't they on the payroll? If they're not directors, they are subject to the National Minimum Wage and Working Time Directive. So what about bringing other family members? I've used the kids as an example. There are rules. There's always rules. You know, if your child's 14, you've got to get the amount of hours that she works, or they work, no gender. If they work, it's got to be controlled. Your council will give you all the information about how long a 14-year-old can work for. Okay? Obey the rules. Obey the rules, people. Okay? But why are they not on the payroll? Now, if they're on the payroll, if you're a small employer, which I suggest, husband and wife with 2 kids get a little bit of money through the company, you're a small employer. And you've got more than just a director on the payroll now, excuse me, then the first £4,000 of employers' national insurance in the year is free. So if you now go back to that earlier one where you've bumped up the salary, yes, there's employees and employers, NASE, but you got the kids in, not only are the kids getting some money because they've earned it, they have got to work, they've got some evidence there, folks, but actually they've just saved you having to pay national insurance as well on the employer's national insurance. There's rules, I'm sorry, I know, but stick with it. You must do it properly. Again, I see it all the time. People come to us and say, oh, well, I know I can take 8,000 quid out, so I did. I was just taking 8,000 quid out. I called it salary. You didn't run it through the real-time information, the RTI. You didn't process it properly. I'm sorry, it's not a salary. You didn't process it properly. It's now going to be considered a loan. Pay the money back because you didn't process. Do your processing, please. Get your paperwork right. Pension. Great. Talked about rules. The amount of rules here are just phenomenal. But if you take a pension payment from your company, the amount you can take needs to be controlled. You need to get advice, etc. I know I'm going to sound like a crap record here. But you put money from the company into your pension, the company gets a tax relief. And of course, you don't get the cash, the pension did, so you haven't got to pay income tax on it. That's wonderful. There is this cap on contribution, so hence the reason why you need to take advice. There's also a cap on how big is your pension fund, etc. But just for an example, allow me just to use an example. Let's imagine that you've taken a pension contribution from your company, you've had a damn good year. You've got an extra £40,000 profit, well done. Pay it over to your pension fund. Good, cash has left the business, it's in the pension fund. The government gives you tax relief on that. They've just reduced your company tax bill by £7,600 because you've given your pension fund 40 grand. Wow, that's nice. But if you're operating a SaaS, again, in a controlled fashion, you can operate your SaaS as like a JV partner to you. Your SaaS can lend you money. So it can lend you 50%. So let's visualize this now. You put 40 grand out of your company into your pension fund. It's yours. It's for your future. The government knocked up 7,600 quid off the company tax bill. It only cost you 32 grand so far. And you get to use 20 grand of your money. Wow, that's not bad. So pension funds, SaaSes, something you really do need to have a look at.
So if you set this up, okay, I mean, what sort of things can you use? Say if you put 40 grand in, and you can use it as a JV partner, to you as your business. So what sort of money, what sort of things could you use with that £20,000? What do you do with that? Could you invest it and things like that?
Well, yeah, you can use what we tend to suggest. I nearly took a gulp of tea there. What we would suggest, again, I know conservative. Okay, I am a careful person. I don't like the idea of your pension fund going into a long-term investment. I personally don't. That doesn't make sense to me. I like multiple streams of income. I therefore like to have a pension sitting to one side, because if all else fails, I've always got that.
Yeah.
The idea of using it as pump priming, though, let me get this deal started. So let's imagine you were doing a flip, and you put it through your trading company, not your investment company, and you've borrowed the money because I'm on a 3-month, 6-month deal, done the deal, well done, I made a profit, give the money back. So the money's there for a very short period of time, and you've got it in a very controlled, planned fashion. I like that,
right?
Personally. You can borrow the money or you can get the company the pension fund to JV with you on commercial deals. Okay. Now, again, we're talking about good IFAs here. So I'm treading on their territory now. So I keep saying it's not professional advice, but treading on their territory. If you visualize a situation now where you've got a hierarchical structure, brokers are now crossing themselves. They don't like me keep talking about hierarchical structures. You've got the owner at the top, a group company underneath, and then a trading company or investment company underneath that. The SaaS can't loan to the investment company to buy a resi. They can't do that. But it can loan to the group company on a 5-year deal. And the group company can then loan it to the investment company.
Right, yeah.
So we always say, try and keep it to commercials. It is feasible to do resis through a hierarchical structure. Still don't like the principle of you investing that cash into a long-term deal on an investment property. Personally,
so your sort of advice would be, yes, you can use it as a loan.
Yep.
But try and structure that as something which is used as seed capital to do something that you're going to get back at a certain point, and you sort of know where you're going with it. So the analogy of doing something like a flip, like buying it, refurb, sell it on, take the profit out, put the money back. So you know the sort of time scales, the structures, and it feels safe. And I understand why you're doing that, because it is your pension money. You need to put it back in.
Well, there's no words I can add to what you just said, Andy. 100% agree with you.
It's just making it as simple and using it to leverage. This is a great way of actually leveraging some cash to do to a specific job.
Yes.
Get it back in there, and then you can you do it on multiple occasions? Is it so if you put say another 40 grand in, you've got 40 grand. Now you can actually
put another 40 grand in. You've got £80,000 now. You can borrow 40. Yep.
Right. Okay. Cool. So that could be very
19% relief all the time.
Yeah. So what you're actually doing is because you're putting it into the pension, it means you can lend it to yourself, so you don't have to go to external sources for to lend money to do certain things like refurbs and flips and things like that, or those sort of short-term ones. Okay.
Absolutely. And the external source, there is an external source. The external source is you with the SaaS hat on.
Yeah.
So it is an external source. Think of it that way.
that it has to be paid back. It's not your money; it's the pension's money.
It's the pension's money, and at the end of the day, if you are a believer in the multiple streams of income, the pension should be there. It is the ultimate safety net. Personally, I make sure I've got my state pension in place, because if everything else failed, I'm not going to actually hit the ground. I'm going to get damn close to the ground, but I'm not going to hit the ground. Now I've got my pension fund on top of that. Good. So actually, I'll probably be quite comfy. Actually, on top of that, I've got my investments. I'm fine. On top of that, I've got my companies, and I've got my dividends and my long-term investments. I'm really okay. But it is a safety layers.
Yeah.
And I don't like people misusing their pension. Personally, without giving pension advice, but giving business advice, I think the idea of long-term investment like a pension into a deal just worries me.
Yeah, I get that. Yeah.
All right.
Yeah.
Take advice. If you're a client, if you haven't got a good IFA, if you're a client of ours, if you're not a client, don't come and ask me to give you access to all my stable of good guys. If you're one of our clients, we'll introduce you to all of the people that we know, like, and trust. I've worked with them for years. I'm very happy with them. There's pension. Moving on. Interest. Let's assume you've loaned some money to your company. Sorry, I know I'm saying it again. Get your paperwork straight. It's too often I see it go wrong. Charge the company interest. The interest you receive could be tax-free in your hands and a tax deduction to the company. Remember, the company is not affected by Section 24. So, tax deductible by the company, tax-free in your hands. Win-win. There's paperwork. Yes, get it done. Now, the maximum tax-free amount is £5,000 for those with earned income at the tax-free level. Again, I've emphasized, and this time I have underlined it, the word earned. So let's imagine, go back to slide number 5, I think it was, about your director's fees. Let's imagine you've decided to take £12,500. Fine. I don't care if you've got 30 grand's worth of dividends, because dividends are unearned. This stipulation is on earned. So you could have £12,500 of earned, £30,000 of unearned. I'll ignore the 30,000. I'm now looking at the 12.5. You can get up to £5,000 interest of interest tax-free. Wow! You get some more tax-free money. You get 12,500 tax-free. Now you get another 5,000 tax-free. We know we're going to do dividends shortly. These tax-frees are adding up a bit now. Let's imagine you've still got a job. And you've got a salary. You're still a standard rate taxpayer, but of course they're paying you more than 17.5 grand, hopefully. But you can still get £1,000 worth of interest tax-free. So why are you not charging interest on the loans to your company? Well, usually because you haven't done the paperwork properly and no one gave you the advice. Think about charging interest. Would you like another £5,000 tax-free? But these are all structured together now. You can see what I'm doing. I'm building on top of each other. Okay, I'm going to stop at this slide for a minute. I'm not going to put the first lot of words up. I told you there was an area where we have spent literally 2 years. This is it. You'll see in the top corner there, top left corner, it's one of our logo brands. Hopefully by now you know what our logo brand looks like. It is the focus on, you see the magnifying glass, intellectual property. Huge topic. It's not uncommon that other accountants are watching my presentations, and all of a sudden they're now communicating with their clients saying, something you should always think about is, and they regurgitate what I've been saying.
Yeah, noticed.
Thank you. I notice it all the time. All these experts that suddenly popped up. I never heard of them last year, but now they're an expert. This one, we spent 2 years gathering and garnering and developing our expert knowledge before we even told the market we're doing it. So it is something that we're handling. It is another string to our bow. So now I'll explain it. But my point is, please don't go to non-experts. Come to the right people. Okay. We're talking now about a style of business where there's something unique about you. I don't mean this disrespectfully, but we're not talking to a Me Too business. Now, a Me Too business is, I've been to Simon's Mastermind Accelerator. I've jumped onto his Mastermind course. I'm going to buy properties and I'm going to rent them out. Good. It'll work. That's what we do. You're just a Me Too. There's nothing special about what you're doing. You're just another one. But there are some investors out there, certainly some traders out there, a lot of traders out there, where actually what you're doing is quite unique. You've created a brand, you've created a style, you've created a marketing method, you're creating funnel tribe brand for Andy. I can see Andy should be dealing with his IP, for example. He does great work. If you don't know, check him out. Right? His free stuff is fantastic. Anyway, something where you're creating some goodwill that has value. Okay. If you created it, you're the guy spending the weekend doing it. You're the one that registered these brands. You spent the money, you spent the time, you created it, you owned it, not your company. You've actually got something which you could rent out. You could rent out your IP. Okay. The really exciting part is there is some capital worth on this one, and that's what I'm not going to be talking about today. If you want to get involved in that, come and talk to us. Let me stick with the income rights.
Yep.
So what you can now do, yes, it's specialized work, come to us. You now rent your IP to your company. Okay? Your company's got an expense, it's tax deductible. You've got an income, it's taxable. There's no national insurance on it. So the company's going to get 19% tax relief. Let's assume you're a standard rate taxpayer. You're going to get 20% tax. It's almost tax neutral, isn't it? But don't forget, we're creating capital worth at the same time. Okay? That one's quite exciting for longer term stuff. If you've got something really quite unique and you're not a Me Too type of business. Think about intellectual property rights. Remember what I said, you're going to get the experts pop up and say they've been talking about this for years. No, they haven't. We have. Okay. Dividends. Okay. I don't going to spend too much time on this one. You should know by now, if you're a limited company owner, that the first £2,000 that you personally earn from dividends in a year is tax-free. Now, if you get some shares in British Telecom and all the other places, your taxes from your company have to be added to that. It's not £2,000 per investment. It's £2,000 in total. They're tax-free. Now, remember, we've got personal allowance. Remember, now I've got £5,000 of interest allowance. Now I've got £2,000 of dividend allowance. Not bad. Okay, I'm now up to nearly £20,000 of tax-free cash. Not bad. And above that, at 2,000, up to your standard rate band, it's 7.5%. So there's no tax savings in the company, but it's a low tax rate extraction of profit from the company. But I want you to be careful. Be careful of settlement legislation. Seriously, pay attention to this. Every day my company grows, we get new clients. We look at the historic records. A huge number, I mean huge, have historically been declaring illegal dividends. All right. Now, Andy and I did a presentation on this a few weeks ago now. If you want to get a copy of that video, speak to Andy, speak to me.
Well, we can put it into the comments afterwards.
Brilliant. Thank you, Andy. So I'm going to give you an example of what not to do. Emphasize, not, underline, bold. Okay. Actually, that was capitals as well, wasn't it?
Yeah, absolutely.
A whole lot there. Don't do this. Your company's owned by husband and wife. 50-50. One of you's A, one of you's B shares. You made £30,000 profit. It's available for distribution. And you say, oh, well, I've got a job. Give it to the missus. And you give the missus 30 grand. You can't. Because there isn't £60,000 worth of dividend. You were entitled to 50% of the dividend. Right? You'd have waived your right to a dividend. Don't waive your rights to dividends. Watch your dividend values. Okay? Don't watch for an illegal dividend, please. Be careful. Okay? As I say, we've gone into this at some depth, not huge, but some depth. Some weeks ago, and Andy will put it into the comments.
Yeah, we'll put the link in. I think the thing about a lot of this stuff is quite simply that there's so many different things you can do to minimize the amount of tax that you're paying, or to eradicate tax in some aspects as well.
Yeah,
but it's the culmination of everything. It's the doing a bit here and a bit there and a bit there. It really does mount up a lot.
Yes.
But there's also these sort of traps that you think are logical. Like, for instance, doing something like, say, if me and my wife Simone are business owners and we have AB shares, and me sort of just saying, okay, we made 50 grand, but I'll give you the 50 grand. I'll let you have the 50 grand. It sort of seems like a logical thing you can do, because why wouldn't you? Why wouldn't you want to do that?
Yeah.
But that is a big no-no, and you're going to lose out in the long run. And it's just like not knowing little things like that to get the best out of all this.
Yeah,
it's just these little things this is why I think tax is such a pain. It's like why people tend to stick their heads in the sand with a lot of this stuff and just like leave it. They don't really follow it up, and this is why I think it's so important to have an accountant that goes through these things and asks you the right questions and gets it all out and takes over, because it's like a lot of this stuff, I don't want to do a lot of this stuff myself. I just want to know that it's being handled, and that someone knows what they're doing.
I've got the biggest smile on my face. You're saying tax is a pain, and I'm actually thinking, no, it's really good fun.
No,
it's really interesting. And I think, oh damn, you're such a nerd. I actually read this stuff and I enjoy it. I spend about 20 hours a week, literally. Think about that. Half my working week, I spend that time reading,
absorbing information and working out
more and more, and disseminating it out amongst the team here, there. I've also got colleagues doing exactly the same, tax managers, other directors. Yes, we are working more than 40 hours a week, but it's great fun.
No, it is. But this is the whole thing, though. It's just like, when I'm talking about the marketing side, and people say, "Oh, marketing's a pain." I love it.
Yeah. Yeah,
it's what I do every day, and I read loads of stuff, and I watch loads of videos, and I come up with all these different, there's different ways of actually you can do things, and best routes for things and stuff like that. And most people are just, when I talk to them, they just go, not interested, just want to go.
Well, you tried it with me, talking about how I should do things, and I slowly am learning from you, Andy. So I am trying,
and I'm slowly learning from you on the tax side. It's like a win-win.
Absolutely. Okay. Number 10. I said there was 11. This is actually, in truth be told, there's only 10. I'm telling you. There's 11 is to say, be careful, folks. So I'm going to do a be careful. So I decided I'd get to 10. There's more that I could probably do, but I've got to 10. All right. And you're probably quite surprised to see employee loans as being an efficient extraction. How the hell? So let me explain. Now, again, please, the DIY merchants who said, "Oh, I listened to what Mark said on a broadcast, I'm doing that." Really? No, please, get some advice and get it done properly. It isn't used all the time. It's very particular circumstances. All right. I know clients are listening to it. There's one of my chaps who I know wants to borrow a huge amount of money. We've gone through this process. It will work. Okay, it does work. We've used it many times. I'm going to explain this by giving an example. Imagine you regularly extract £40,000 a year from your business. Okay, however you do it, 12.5 grand, salary, bet dividend, you take 40 grand. Okay. You've had a bumper year, something fantastic's happened. You've got some extra cash in the business, not every mortgage, something, I don't know. You've got some cash. There might be some profits to justify some dividends. If you took that and you want 50 grand, you need a new car, you need something, whatever. If you took that in one hit, £90,000 income in 1 year, your tax bill, the extra tax bill there, you're up to 13,750 quid of extra tax. So let's imagine you want to buy a 50 grand car. All of a sudden that car's now cost you nearly 64 grand.
Yeah. And that's the way to look at it, isn't it?
That's scary numbers. Now, would you pay a premium of 14 grand to have that car? Wow. So, sorry, tech crikey, I know. You're on 40. Take 10 extra now. Take an extra 10 now. So you're up to 50. You're still standard rate. And borrow 40. Now, on your tax return, the company's tax return, you've got an outstanding loan of £40,000. Your accountant will say you've got a tax bill under Section 455. It isn't really a tax bill. It says tax bill. I can't call it anything other than a tax bill. It's on the tax return. It says tax bill, but it isn't a tax bill. It's a loan. You've borrowed 40 grand, therefore loan 13 grand to the government. They don't call it tax, but you're loaning them the tax. Okay? It's not permanent. It's a loan. You've borrowed 40, give them 13. Now imagine in the next year, you say, well, I'm still taking 40. I'll tell you what, I'll bump it up to 50. I'll take another 10 grand. Do it properly. You've physically got to pay the 10 grand. You can't just offset it in the books. You physically got to pay the 10 grand. You've now got the cash. You physically pay back to the company saying, here's your loan back. Here's 10 grand of your loan. At which point the company says, oi, government, I've had 10 grand of my loan back. Give us 25%, 10 grand out of 40. Give us 25% of my 13 grand back, please.
Right.
And you get your money back from the government. It's knocked off your tax bill. You don't actually get the money back. It's knocked off your tax bill. Imagine you did that for every year for 4 years. Well, you haven't paid any tax. The 13 grand has all been paid back to you now. Yes, you've got to pay interest on the loan. The interest rate is 2.5%. That's the statutory rate. You physically got to pay that interest as well, folks. But I've just taken your tax bill down from 13,750 quid to 3,750. I've just saved you £10,000. And I spread it out over 5 years or 4 years. What's the value of money? And it only cost you a little bit of interest, which was peanuts. All right. You can use it in certain circumstances. It's useful. Don't immediately all go out and borrow money from your company. You must take advice. Okay. Good way to take some money out though for the one-off deal. Now I've got clients who've said, yes, fine, I need £250,000 because I want a deposit for a nice house for me. And the cash was there and they've done it. And gradually over time, you pay it down. Okay. So I've used examples which perhaps aren't that big a number. It's done with bigger numbers too.
Yeah, I mean, and any of this, I mean, it just enables you to pay less money and get the same result. And
yes,
and this is the whole point of it. It's not trying to be clever and trying to just minimize tax. It's just basically using money in the right way. And this is what I like about a lot of this stuff, is because most of the things we would just go and we'd just go and swallow that 13 grand, you know, that, or nearly 14 grand. We just swallow it because it's the easiest route to do.
Yep.
But the amount of work that it takes to take out the loan and then pay back the loan over 4 years, the amount of work that it actually takes is nothing. Really.
No, it isn't. Really isn't.
It's a bit of paperwork and just adhering to a concept.
Yep.
And it's not that much work, and it'll save you 10 grand.
Yep. So if you think about what I've done here, I'm talking about the cars earlier on. Can't remember which slide it was now. Number 4, I think. And I'm saying, no, gas guzzler. No, sorry. No, put it in your own name. Didn't mean to say you can't get the cash from the company, though. You could have got the cash out of the company. You could borrow it out. So everything is connected.
Yeah.
Everything. But it's planning. I always say that tax is just like your Vodafone bill. It's just another bill. Plan it. Manage it. Why are you not planning your tax bill? Why are you just suffering your tax bill?
You see, also what it can do. I mean, this the employee loan thing on its own. If what you've just gone through is basically a way of actually going and getting a vehicle that you probably wouldn't have got in normal circumstances. You might not have gone and got it, but now because you understand this process, and this is affordable.
Yep.
And it sort of works, and it's not like a big lump of cash anymore. You know, It's something which is a lot more manageable, a lot cheaper, and it makes a massive difference. And and just having that car could make your business sing. It could
make you sing. And not be funny. It's costing you £3,750 tax bill. It's 800 quid a year.
Yeah, but if you think about it, you know, if to have it's like in a lot of businesses, just to have, a good, comfortable car, you can go and do your job. It makes you feel more refreshed when you get there. You know what a nice car can do. It's not just about making it look flash. It's about the comfort from A to B and things like that. But a lot of this stuff is taken for granted. But those sort of things. If you arrive somewhere for a meeting and you feel energized and you feel comfortable and things like that, and when people see you drive up, they have an impression of you, and all those sort of things can make a tangible difference to your business.
I understand what you're saying, Andy. I'm not a car nut. I don't get it. I'll be honest.
Well, nor am I, to be honest. But
I don't get it. I'll tell you what I do get. I drive my car. Those of you that know me and know my wife, Linda, every single time, I'll tell you now, I get in the car from home, it is literally 75 yards until I get to the entrance, the slipway to the A34. That's where I live. And as I'm going down the slip road, to get onto the A34, my car is purring. It just purrs. I love it. And I say every single time, I really like driving this car, dear. It just makes me happier. And if I'm happier, I do my job better.
That's what I'm saying. These are things like little psychological things that help you in your life, and it's not about having a flash motor and things like that. No. But to me, it's like these little psychological things do actually help. If you can arrive somewhere and you're going to a meeting and you feel more energized and you feel fresher, you'll have a better meeting and you'll have a better result.
I think so. Right, one more on this slide.
Yep.
As always, sorry folks, specialist advice. Please, I see some of the muppets that you guys engage as accountants. Please be damn careful, will you please? Now, there's something really important here. Bed and breakfasting. Again, we see it much too often. If you take a loan, you've got to pay the loan back within 9 months and 1 day of the end of the financial year. So, okay. And we see people who go, yeah, here's the loan back. And it came back on the Wednesday before the tax return, before the due date on Friday. And lo and behold, next week you borrow the money again. So the loan was only repaid on a bed and breakfast basis. The loan actually wasn't repaid. You just sort of let the money sit for bed and breakfast. Yeah.
Yeah.
HMRC are all over that like a rash. If they can see those loans have happened and there isn't a section 455, they'll come and talk to you and you don't need the expense. So I've done, and damn, I'm nearly up to an hour. Wow. Right. The next one is one I'm asking you to be a little bit careful about. Be careful, please. Again, I know I'm conservative. You've heard of the people who say, well, a trading company, I want to buy some investment property. So I've got a trading company, I might do flips or whatever. I've got an investment company. I borrowed the deposit from my trading company. Then I went to the mortgage company and got 75% LTV. Actually, I've got 100% loan on this property because I borrowed it from 2 different places. And lo and behold, you did it nice and fast. You didn't worry about your paperwork. There's no interest charge. Damn it. Why bother? Okay. Every single day, I see it on social media. I see it and I shudder. Okay. I am a conservative person. I am careful. My job is to stop you going to Pentonville. So let me explain why. The company and the directors, you have a legal obligation to run your business with a profit motive. Your business to make a profit. Why then would you loan money from one company to another one and not charge interest? If you do it for yourself, would you do it for others? Would you like to walk into your local PIN meeting and say, I've got a trading company, got lots of cash in it. I'm going to loan the money out to anybody that needs it, an investment company free of interest. You'll get killed in the stampede. Okay. The reality is you're not doing it for anybody. You're doing it for you because you own both companies. Well, isn't that the definition of a benefit in kind? You're getting the benefit.
Yeah.
It ain't difficult to see behind this, is it? So if you want to do intercompany loans, make sure you've got a legitimate business reason for wanting to do business loans. Make sure it's properly documented. Make sure you've got your processes in place. Make sure the right agreements are there, the right securities are in place. If this is an arm's length transaction, in other words, it's not for your benefit, it just happens to be what the trading company now does, good. Do it properly, will you please? When that brown envelope hits on your doormat, it's really comforting to say, well, I've got all the paperwork in place, it's dead easy, I'll deal with that on Monday. I can ignore it for today. Then we'll deal with it on the weekend. I'll deal with it. It's easy. You've got every process is done. 11 topics, 10 of which I was trying to give you positivity. 1, I'm trying to give you a bit of care.
Yeah.
And that was tax extraction.
Brilliant.
Tax extraction.
Thanks for that. Thanks for that. And you know, the usual thing with Mark is that if you want to have a quick initial chat with him, he will do it.
Don't take the rice.
Yeah. I'm trying to think of I was going to say something, but I thought I better not say that.
No, you can't use that. No.
Yeah, don't take the rise is a good one. I mean, if the bottom line is that you're good enough to sort of give back to the pink community and help people out. And the call is really basically, can you help or not?
Yeah,
that's really what the call's about. It's a discovery call more than anything else, you know. So if you have any issues with things you want to look at, then you can have a little initial call with Mark, and he'll be able to tell you if you can help or not. And that's the thing. So don't take the Mickey. Don't take the Mickey. That's the one I was
that's what you were like looking for. I've had a good one recently. So let me give you a quick one recently. I've had someone from the Pin family, come to me and say, I need to have a chat with you. I think you might be able to help me. Good. What do you want me to help you with? Tell me about it. I can't really be bothered to write it down right now. Can't you just phone me now, and tell me so I can explain it? I really don't want to take the time out to write it down. No. If it's not worthwhile,
if you're not prepared to do it,
briefing me, it isn't worthwhile. Me put my time in. Sorry.
It just bodes badly for the future, basically. If you're not prepared to write something down,
if people can't, it's got to be balanced in all this. So. Hopefully that was helpful. You got 10 good hints there about how to get some tax efficient extraction from your company.
Absolutely fantastic. Listen, I really, really do appreciate your time, Mark, and the sort of effort that you put in. I really, really think it's massively advantageous for anybody in the community.
Thank you.
And we're going to do. I think we got another one lined up for a couple of weeks' time, which we're going to do.
Yes.
So we'll look forward to that. But in the meantime, if you've got any queries, stick them in the comments. We're gonna. This is going to be up for a while, so you can review this at any time. We're going to put it into the units as well in the community, where all Mark stuff is. So if you want to go there, if you just click on units in the group, you can see all the different stuff we do. We do panels and all the rest of it, and expert interviews and all the rest of the stuff in there. So, well, until next time, Mark. Thanks very much for your time.
Great pleasure. Lovely chatting with you again. Take care, everyone.
See everybody later.
Bye.
See you later.